And welcome to another edition of the Nerdy Agent Podcast. I'm your host with my brothers and fellow nerds, AJ and Josh. Happy birthday to you. It's AJ's birthday today. He's getting hundreds of texts. He's going to be texting the whole time. AJ is a whopping 46 today, 36 today. Josh is 40.
Not quite.
Not 40.
62.
They're both really old, and I'm still a young buck. So that's good for me, I guess.
Yeah. This means we're 1 year close to retirement, right?
Yeah, it does. Maybe, debatably. We all kind of. This week, we're going to talk about the CPI and PPI numbers that came out last week. I think they came out on the 13th and the 14th. So our podcast is on Tuesday. So they came out after that. Talk about what the trends are looking like for that, how that's going to affect the market, what the Fed might do moving into the new year to start. Just as a recap, because maybe we have new listeners. Maybe that'd be fantastic for us and them. What are the CPI and PPI? Why do they matter?
The PPI is the producer price index. That is the number that we look at when determining how much the goods that producers need to produce their products, how much they're paying for those products versus what they were paying the previous month or the previous year, or over a 12-month basis. And then the CPI is the consumer price index. So that's the prices that consumers are paying for goods and services on the same cadence. So they look at it on a month-over-month basis, and then they also look at it on a 12-month, year-over-year basis to kind of determine if they're hitting their overall goals. That's they being the Fed.
And they say that, well, the PPI in general is kind of a leading indicator in the CPI, possibly because it's the cost of what it is for them to produce it. So then they pass that cost on to the consumers. Before we start looking at that data, I'm just curious, are they predicting that obviously if tariffs go into effect, they're predicting inflation will go up. Do they think that, obviously it hits both of them, but like, does it hit the producers?
I was just wondering that.
Does it hit the producers that cause the final end product to go up? Or does the final end product directly go up because it's just from another country? Does that make sense? Like,
which measure will it hit, you're saying?
First, I guess. Yeah, I don't know.
It would probably... I don't think it's going to hit domestically on the PPI because it's not going to be on domestic goods and services.
Yeah,
we'll do some research.
It will be on the CPI, however, because the product is sold in the United States. But if the product's not produced in the United States, it will not be on the United States PPI, in my opinion. But if it's a part of the product,
then it will. So if you're talking like,
country,
let's say
they need a board for a computer.
Yep, tariffs are explicitly excluded from the PPI because they are considered a tax. Oh, interesting. So they're just going to be on the PPI or the CPI.
CPI. Mm-hmm. Oh, so then you could say the PPI might not be a leading indicator in 2025. Inflation. You heard it here first. That'd be interesting.
That would be interesting.
So what were the PPI and CPI numbers for last week though?
So CPI rose 0.2 in October over the prior month, so slightly up at 2.6% year over year. The 2.6 is the number that more people are paying attention to because the Fed has kind of consistently set a benchmark of 2% for their goal for annual inflation, and in line with where we kind of thought it was going to go. So all of that is positive economic news in the sense that, the goal with inflation was get inflation down to about 2% without crushing the economy with all the overnight rate increases. And it seems like that's kind of what has happened. We've stabilized the inflation numbers, and economically have not had a massive impact in terms of the jobs report or, housing, et cetera. So it is interesting to see kind of that it seems to be going well, which is a good sign theoretically for where the overnight rate will go in the future, because if the Fed feels good about where inflation's at, they're going to continue to evaluate cuts. Two things are kind of more on the negative side. We talked about tariffs last week, and so that's going to definitely impact Fed behavior because if tariffs are going to go into play, we might see more risk of a future inflation. Therefore, they might be more conservative in their decision making. And then on top of that, housing is an interesting one where the biggest driver actually of like CPI just struggles is that housing is up 4.9, or no, that's energy. Sorry.
Energy's up 4.9.
Energy on a 1 year basis was, off 4.9. So declining 4.9. Housing, though, is also up 4.9. So the shelter index is the biggest thing that's kind of driving up or is above the normal inflation levels.
Isn't there a lot of internal battles within economists determining what that shelter pricing is and if it actually accounts for the right things?
Because it's mostly just the owner's equivalent of rent, right? So it's like a survey of homeowners, and then they ask them how much they could rent their house out for. Isn't that the most of the shelter pricing number?
That would be something that we would need to do more
Yeah, I
research
think it is. I mean, either way, I know there's a lot of people that have said it's not actually like the prices of real estate being sold necessarily. It's more of an owner's equivalent of rent. But you guys can look that up in real time here if you'd like to. I think the more interesting number to look at, I don't know if, the Fed's definitely not going to publish this number because it doesn't make things look good, but what was the if you look at the index and you could index it from 2020 October to 2024 and then divide it by 4, what would that be?
Oh, I don't know what that is. We'd have
That's
to
got to
run
be
that.
pretty
Let
wild.
me give you the shelter pricing CPI first. The shelter pricing CPI refers to the component of the consumer price index that tracks the change in housing costs, including both rent for tenants and the estimated rental cost for homeowners, known as owner's equivalent rent.
Yeah, so it's mostly a rental price, so it's not necessarily the value. I mean, I'm sure,
Like, yeah, you would think it's the price of houses.
Yeah,
but
but
the cost to live in them.
right, because I think part of the problem is what we've talked about with real estate before is it matters what houses are being sold. So, like, when you look at the overall median sale price across a large market, you probably get it to be a big enough sample size that you get a real number, but it still isn't accounting for the fact that, like, maybe all the luxury homes in Minnesota aren't being sold, but all of them in Florida are being sold, and maybe cheap homes are being sold here and not cheap homes are being sold here. So how do you determine actually what the overall value of real estate is when the only numbers you're getting are the ones that are actually selling? You're not getting the value of like our 3 houses in that number because they're not being sold. And so how do you actually know what the value of it is overall, right? I mean,
And the interest rate that affects that a lot.
Right, you're kind of you kind of create a self-fulfilling prophecy theoretically, right? If you raise interest rates, housing will get more expensive on any person who's buying housing, which then theoretically, if it rolled back into the index, would just cause a cycle of constantly raising rates. Where you go, we got to raise rates because if housing's too expensive, we got to cut behavior, and then
it gets more expensive.
So, yeah, I think that's why they probably exclude it from that.
And the rent number does matter because, like, if people in real time are developing land, they're building apartments, or they're buying rental property, they're buying it at a valuation that is determined by the rent price itself. The rent price and the sale prices of properties are very highly equatable, I would say. They follow the same trend line.
And if you're trying to think about, like, do people have money or do they not have money, right? Or is their life more expensive? Is it less expensive? Rent would be the one area you'd probably zero in on.
I'd love to see if we can get that number, though.
What's the number you're saying?
Like, what would be the October 2024 until October 2020 until October 2024 overall CPI increase? And then if you divide that by 4, how much are we actually at over the last 4 years?
Oh, sure. So like it was 1.2% in October of 2020. I have to add all these data points.
No, I think you would
just have to look at the base data.
Yeah, we could figure out what the index
We have to
says, but I'm wondering because it got up to 9%. So if you look at 9% on a 12-month basis,
9.1 in June of 22.
It would take 4 years of 0% inflation to actually get close to a 2% number normalized over those years.
Yep.
Which is like what we talked about before, which is this term that I want to introduce, and I want to see if Luke can answer what it actually is. So this is a concept that scared a lot of people once the inflation number went up to like 9%, because when inflation goes that hot, and let's say, most people in America have less than $1,000 in their savings account, right? So we know that's a real stat. And so when their lives get 9% more expensive, quote unquote, on average, or whatever you want to call it, they don't really have the margin in their budget to actually account for that. And so what they have to do is they have to go to their employer
And ask for
a raise because they say, I literally can't afford my life. So I either need to get a new job where I make more money, or I need to find some way to cut out of my budget. But my budget's already like a zero budget. Like I'm just paying for gas, food, rent, and clothing, right? Like, so I can't afford to do that. So then they go and they ask for a raise. Well, if that happens across the board, then what happens to wages?
They go up.
They go up. And then the companies have to charge.
They have to raise their prices.
More money for their products to continue to make their margin, right? It's a simplified version of what actually
You know what
happens.
this term is called.
But it's called the wage price spiral.
That's what it is.
Wage price spiral. And it didn't really happen. I mean, like, modern day economics is far more complex than life's more expensive. I ask for a raise. I get a raise. Products get more expensive. And then the cycle just continues on. That's why they've been able to tamp it down, because there's companies making less margin. There's companies maybe investing in technologies to cut actual people. There's a lot of different things that happen, or they slim down and maybe a worker that was working, maybe there's 3 workers working these 3 jobs, and now there's 2 workers working those 3 jobs, like Josh talks about in corporate America happens all the time. So it's not like a one-to-one comparison, but it can happen where that just perpetuates itself and gets worse and worse and worse over time.
And it appeared like they theoretically, because we talked about that potentially happening 2 years ago, they theoretically handled it decently. It doesn't seem like it. I mean, obviously, inflation hasn't went to 0 for the last 4 years to even out to 2% consistently. But it's been going down.
There's still been internal turmoil, I think, amongst people who are way smarter than us of, are we using the right numbers? Like, is the data, we talk about that in our business all the time. Is the data actually even correct? Or like, are we, we talk about the employment stuff. Well, it's like, well, there's a lot of people right now that are working like 2 or 3 jobs. Like, how does that get factored in? How do the workers that were, maybe working a W-2 job as a bartender that are now doing Uber on a 1099 basis, like, how do they get factored in? Are they even being counted? Luke's talked about a lot of business owners in our country that don't even file taxes. Like, so how do all of these numbers kind of work into the overall number, and are they using the most perfect data? I think they're, a lot smarter than we are. So I'm hoping that they're probably using it, but I do think it's peculiar that they use the fact that most Americans, if they get enough, most people, human beings, if they get a number smashed into their head over and over and over, 2%, 2%, 2%, and then Fox News and CNBC and CNN all just plaster 2%, 2% everywhere, and they go, looks like we're getting closer to 2%. But then you really look at it and it's like, well, really, we're at like 5 or 6% on average over the last 4 years, which still doesn't solve the problem. Like, you actually have to have under 2% if you want to achieve 2% over a long period of time.
Yeah, I think they're also, though, thinking about it from that you start year over year fresh. I mean, I understand that during COVID, it was just chaos because we were all living during an era where things were so much more unique than we're used to. And I'm guessing at this point, and we can even see this in like the one measure we look at a lot is the affordability index internally, because that factors the wages in versus the cost of housing, right? And so we have seen, I was worried that number was going to just crumble because if wages didn't come up fast enough, the housing prices had gotten so expensive that there was no way it was going to work. But we've seen that number actually kind of stabilize and come back a little bit, even though we're still seeing appreciation within home prices and the rates are high. The wages are starting to catch up a little bit.
Wage growth has been good.
So we're kind of finding a more balanced number there. But you're right. I mean, everyone's trying to aim for certain targets, whether they be for, reasons of trying to support people or trying to support themselves and, political reasons. But I think the reality is at least we have enough numbers to kind of get a good sense of where things are coming in on some of these.
I still think, though, like, when you're in talking with just ordinary, like, just our own budget, our friends' budget, like, just talking to people about how they're doing their lives right now, I think everyone is feeling like everything is just a lot more expensive than it was 4 years ago.
Prior to 2020. Yeah.
Like, a lot of them are feeling that. Like, people that make good money, like, that I talked to, they're like, man, you can't even live off of X amount of dollars with a family of 5 or whatever, because everything is just more.
The joke on Twitter, which formerly known as, is that back when our parents, like in the 90s, what's it called?
Blue Sky?
I don't know what it is.
That's the new app.
That's what they call it.
No, that's the new competitor. It's basically the same
There's a
thing.
competitor.
Yeah.
Back in the 90s, it was like $100,000 is now like $250,000.
Yeah.
Is like the comparison that people are making.
Yeah.
But I do think it's interesting. I think there's definitely a psychological component to that, because a lot of what the Fed does is psychological, and they don't want, like, it would debatably be worse if they came out and said, well, it's actually 6% versus like, hey, it's looking better.
It'd be way worse.
Yeah, I think people would just go chaos, and then once
calamity.
chaos happens, society breaks down.
It's calamity. They are trying, there's a control aspect of the whole thing for the good of the country.
Yeah, for sure is.
It's not, I don't think that, Jerome Powell's like, I'm going to control all these people.
No.
But it is like, I know what I'm doing. I can get this to a point where I think it's okay.
It's gonna work, yeah.
And I'm going to let everybody, like, I'm going to make it seem like it is okay because I think it's fine. But if he comes out and says something crazy, then everyone's going to
freak out. Crazy.
Hair on fire.
Let's tie this into real estate, though, somehow. Yep, somehow. Because talking about CPI only. This isn't just
the somehow is on the CPI and the PPI. The numbers were about what we thought they would be.
Yep.
That's always good news when it comes to real estate, both in terms of saying, okay, people will be less likely to be massively impacted by the inflation, to AJ's point, we did go through that cycle of massive inflation coming out of the pandemic just as a result of all of the chaos that happened during the pandemic, whether it was printing money, whether it was supply chain issues, all of these things. That was an unprecedented time that created massive inflation numbers. So things are just naturally more expensive now than they were before that had happened. But now we're seeing more stabilization, which means people are going to be a little bit more comfortable financially as we head into Q4, et cetera. When people are more comfortable financially, they're more likely to continue to behave in a way that is a little more rational. And we're likely to see more stabilization within interest rates if things come in about what was expected. If they come in below expectations, like if CPI would have been like 1.8%, you would have seen much more likely that they were going to cut rates, which would have led to a decline in mortgage rates because of that. But it stayed about the same as where it's been. I've always argued that stabilization in rates or small movements down are the best thing for the marketplace because it's going to lead to similar behavior to what we're already seeing and or maybe a slight increase in behavior, which is always what as real estate people we're wanting is an active market, but not a chaotic market. And so I think right now we're in kind of that like neutral market as we head into the winter timeframe, which is naturally a little
Josh, would you say though they are who we thought they were? Is that
Do we
say?
in terms of the market or in terms
Yeah.
of what?
Have you seen?
Oh yeah, the Denny Green.
Yeah.
Yeah. Oh yeah. It is. I mean, I actually thought that we would see lowering of
Maybe
rates
that's what I heard, too.
faster. I thought they'd move down a little bit quicker. Now the whole tariff thing is going to throw a wrench in that. And then just the fact that I think the Fed is treading cautiously, which I should have foreseen, but I thought there was this pathway to a lowering of rates that I thought was happening, but it seems like we're probably going to be more status quo until at least Q1.
So my question for you is, what did the Fed say? What are they saying the Fed's going to do? Like, what are the predictions now? Because the initial thought was, well, this was pre-election. I think the tariff thing throws a little bit of a wrench somewhat. But they were saying the Fed's going to cut 25 basis points.
I think they're gonna. Their
target
still
was down.
supposed to keep going.
And they're meeting in December, right?
Next Fed meeting is December 17th to 18th.
And I thought initially
why they
were gonna-
expected to reduce by 25 basis.
they still are planning on doing that.
Yeah, the Fed,
Okay.
the benchmark rate still, the target rate is at 3.75 to 4. Right now, they're going to move to a range of 4.5 to 4.75. So we're still, that's what they're expecting.
No,
to
it's
do.
4.75 to 5 right now.
They're expected to reduce to 4.5 to 4.75 in the next meeting in December.
Yeah.
So the expectation is still that we're going to see quarter point cuts,
Got it.
for the next 4 meetings, but all of that ends up being data driven. So in the short term, that can be the expectation, but
Could change.
the market is always going to price in their own expectation beyond the expectations that they're being told. And the fact that we're not seeing a faster decline in the actual rates suggests that people are a little bit weary that this might not be the reality that they're going to see happen.
That's what I'm thinking. There is a chance they just say we're halting in December.
I think December's likely to happen.
Yeah.
It just seems like there's quite a few people that are believing that. But after that, then now we have a new administration, we have new policy. We're going to see what actually happens. Then maybe from there, they'll probably play it by ear.
So it'll be interesting to see what they do and how the secondary markets react in December with where the 30-year might end up trending in 2025.
Exactly.
Most people thought it was going to be lower right now than it is at the beginning of this year.
Mm-hmm.
Well, the 10-year Treasury took off after the election, so that's part of it too. Is that's up to it was over 4.4,
over 4.5 briefly.
Yeah, and it's back down again today. But we were down in
4.35.
It's 4.37 right.
You know what's interesting? Just to wrap a bow on the real estate concept a little bit is the spreads right now. And I've talked about that on the podcast before. I talk about with our team all the time. The spreads are shrinking like big time.
Spread between
the 10-year Treasury yield and the 30-year fixed mortgage rate. And between 2013 and 2019, that number was 160 to 180 basis points. So the 10-year Treasury yield, if you just took it and you added 1.6 to 1.8% to it, that would give you the 30-year fixed mortgage rate. In 2022 and 2023, that number was over 300. And now it's back down to 250, 260. What's the rate?
What's 4.375 to about close to 7 right now?
6.9, yeah. So 250. So you've seen a half of a basis point shave off of, if we were
7.08 on Mortgage News Daily right now.
Yeah, so 2.7, 2.6,
2.7, yeah.
Yeah, but either way, I mean, you're seeing the rate today would have been 7.4 in 2023 based off of the current 10-year Treasury yield. So it's interesting to see that because that would suggest to me that usually when I talk with people about these MBS markets, it would suggest to me that there's a lot more liquidity in the mortgage-backed security markets. Like there's more volume, like they're trading higher. There's a lot of stuff happening. So it's a more frictionless market than it was like last year. It's still less frictionless than it was back in the 2010s decade.
Yeah.
And the majority of that's because the Fed's no longer buying mortgage-backed securities. So you're going to see it kind of bounce around here, but it's nice to see that the mortgage market is seeing like some clear path to, keeping an active market again and keeping rates a little bit lower.
I wonder what the projection on that spread is for 2025.
I think until the Fed says they're buying mortgage-backed securities again, it's probably not going to go crazy. But yeah, I think you could continue to see it compress, hopefully, if that becomes a more stable type marketplace.
Mm-hmm.
Well, we went hardcore nerdy today. That was as nerdy as it's been in a while.
I mean, we talked about tariffs last week, so I don't know about that.
That one was pretty nerdy.
Yeah, it's good.
And happy birthday to AJ. Are you doing anything tonight?
I'm watching Holden sing in his 3rd grade concert.
That's a 30.
Daphne asked me what I wanted for my birthday, and I said a hug, and she said, no, you get things. I said, I don't want anything. I have all the things that I want. And then she didn't even give me a hug. All I want is it was a free gift.
That is a 36-year-old birthday if I've ever.
I said hugs from everybody, no fighting the whole day. And Holden said, how are we supposed to do that?
It's so true.
Use it on social media. That's all we have this week on the Nerdy Agent podcast. And as always, remember, be better.
Bye.